Andrew, when you look at some of the restrictions or the possible lockdowns, does it really make a difference for what asset classes or what countries you want to be invested in?
Yeah, so I actually think that here it's important to keep something in mind that what I think the market probably prefers longer term is maybe at the risk of stating the obvious, better control of the virus. And so more lockdowns can be fine, maybe can even be preferable, if they result in a better long-term outcome. And so, right, I think it's quite clear that if you don't lock down sufficiently, it's a little bit of a kind of a false sense of security. It doesn't fix the problem, and the market can see through that. So, moving to more restrictions, I don't think the market would that's not the real problem. I think the market would actually probably be more concerned if it felt like sufficient measures weren't being taken potentially to prevent a longer second wave. So, for markets, we think all of this continues to drive a pretty choppy period of, kind of ahead of the election. You have COVID uncertainty, you have election uncertainty. But I think, as we look towards the end of the year and into next year, I think that uncertainty should ultimately recede.
So, Andrew, where do you want to put your money right now? What's your best play?
Yeah, so I think there are a couple of things that we like. We do like being short U.S. interest rates. We think that the risk reward for that, for being short duration is quite good. That again, I think you're looking forward to a reduction in uncertainty going forward. Right, by December we should know more about the progress of the vaccine. We should know more about who's the next president of the United States. I think there are multiple political scenarios that could drive more fiscal stimulus, and long-term U.S. rates are still near their all-time lows. So I think those are already discounting quite a bit of bad news on the COVID front or the market uncertainty front. So that's something that we like quite a bit. We also do think that fundamentally, you will see a more kind of pro-cyclical early cycle rotation in markets. That's kind of paused over the last couple of months, but it's still in place since the lows in March, and we think that will still continue. So small caps outperforming large caps, cyclicals outperforming defensives. We still think that that's ultimately the right way to position. And we do think that again, as you look forward into next year, you will probably most likely move back to a period where the dollar is weakening modestly. Again, I think as a function of some of that uncertainty declining.
Is there anything, Andrew, that you liked in the fixed income space?
Yeah, so I think within all of this, we continue to see the best risk reward within corporate credit. It's not the most exciting asset class, but I think that in some ways in the near term that's the point, that we do think corporate credit is a little bit removed from some of these uncertainties around who will the next president be or how bad will COVID be. Just simply because I think credit will be more impacted by the more binary question of will the recovery continue or not. It's also benefiting from direct central bank support, and we think corporate bond supply, which has been historically heavy in the aftermath of this crisis, that will slow down as companies have now borrowed the amount of money that they need to borrow. So, in terms of kind of waiting for some of this uncertainty to clear, we think kind of owning corporate credit and seeing that as kind of a relatively lower risk, slightly more boring way to take exposure is actually pretty good here is through the end of the year, and then then it might be a good time to reevaluate, but not until then.